The Fed minutes are out today, and the market will key in on the latest insights from the central bank. As we break it down, we don't see all that much surprise coming from the minutes, with the Fed already clearly laying out its intentions. Remember, the September meeting introduced two major updates that have now been well absorbed by the market. In an effort to calm investor nerves on the topic of inflation, the Fed replaced its 2% inflation targeting with inflation averaging. This means that investors no longer need to worry about higher rates when inflation hits 2%. The Fed is now allowing room for inflation to be trading above 2% without triggering an interest rate hike response. The second update from the Fed was the extension of guidance out to 2023, yet another move to give the economy as much room as possible to be able to work out a recovery, thereby getting ahead of any uncertainty should the economy not be in a good spot in 2022. Perhaps another important update from the Fed in recent months has been the update that the Fed does not have all the tools at its disposal to bring the U.S. economy back to health, and that for this to happen, there needs to be a greater fiscal stimulus response from government. On Tuesday, the Fed chair was at it again on this topic, going as far as to say the risks associated with too much stimulus were less than those associated with not providing enough stimulus. And so, as far as the takeaways go heading into this event risk, we'd say that it really comes down to more of the same. The Fed continues to lean towards a policy that is accommodative as possible, short of negative rates, all in an effort to keep investor sentiment propped up, and is willing to keep doing whatever it can to promote such a policy. At the same time, the limits to the Fed's efforts are becoming increasingly apparent, and the exhausted nature of these efforts could soon pose serious risk to financial markets. However, it is also arguable that such policy has been extremely reckless, with financial markets already at risk from this unprecedented, excessive period of artificial support from the Fed that has extended beyond a decade and resulted in a shockingly massive balance sheet. But to this point, it comes down to what investors want to believe, and in 2020, investors have still been comfortable buying into the Fed's strategy. Overall, the expectation is that there will be more clarity around the Fed's reasoning for its latest accommodative adjustments, and in our view, this leaves the greater balance of risks to a buy the rumor, sell the fact reaction, which could lead to lower equities and more flight to safety demand for the US dollar. We also think it's worth highlighting the fact that with all of the fireworks around US stimulus over the past 24 hours, the impact of the minutes could very well take a backseat. That's all for now.